The private credit risk, it's not that it's not systemic. First of all, we do not have a compartmentalized economy. Rarely does something affect one sector and it just stays contained, especially when you're talking about trillions and trillions of dollars. It's not that it is not systemic. It's just that the risk and the pressure is being migrated to other sectors at a glacial pace. Glacial pace means it's moving very slowly. So what I really want us to look at is this glacial migration of risk and pressure and how we can take advantage of it, because no one's going to be paying attention to this. You know the drill. This is for information and entertainment purposes only. This is not financial advice. I'm not a financial advisor. I'm not your financial advisor. Make sure you consult with a financial professional. All investments take on a risk of loss of your money. Don't you ever forget that. Make sure you do your own research and your own due diligence. And with that being said, this is a really fun, good, informative episode. One of my best, might I add. Enjoy. So last week we had bank reporting season. All the banks, the major banks, they reported their earnings. And we were looking very, very closely to that because y'all know we've been talking about this private credit crisis, and we're trying to figure out if it's hit the banks yet. And if we got a private credit crisis where the corporations and the shadow banking industry, they're seeing stress. We're trying to figure out if it's regular banking that's seeing stress. And thus, if regular banking is seeing stress, then that means that there is something going on. Systemic is the word that they've been using in the economy, and it's going to affect everyone. So, to our surprise, the banks reported relatively good earnings. Even when you look under the hood, we're going to talk about, we're going to look under the hood though, but even when you look under the hood, basically consumer credit and consumer products, they were not affected just as of yet. And so what that implies is that this private credit crisis is not a systemic risk. What does that mean, right? I've been saying like, hey, private credit crisis is a bubble, and this is going to be the pin that pricks the bubble. And if it's not a systemic risk, the banks aren't feeling it, then it's very contained. No, so like, you know, last week they were talking about how the stock market is up. Everybody's just doing so wonderfully.
Right.
But, you know, we got to figure out what's really going on. So first of all, my thesis is that the private credit risk, it's not that it's not systemic. First of all, we do not have a compartmentalized economy. Life just doesn't work like that. Rarely does something affect one sector and it just stays contained, especially when you're talking about trillions and trillions of dollars, okay? It's not that it is not systemic. It's just that the risk and the pressure is being migrated to other sectors at a glacial pace.
Okay. Glacial pace.
Okay.
What does that mean?
Glacial pace means it's moving very slowly. Here's the thing about human nature that I think everyone needs to understand. All of you need to understand this. Human beings have a whole entire problem. We malfunction with glacial problems. Problems that accumulate and move slowly even if we see the pattern. We don't know how to react. It has something to do with fear, fight, flight. I've been like realized this as a coach. One of the beautiful things about being a coach, I've coached entrepreneurs for so long. That is not my main job, y'all. But I've been in the industry for so long that you see human nature, human patterns. People can't identify patterns at glacial pace, and when they do identify it, they struggle with reacting to it because I think they think that they can bury their head under the sand, or I don't know. That's a whole nother conversation about like judging it and assigning meaning to it and the judgment that you place on it and the meaning that you assign to it and how you react. But that's neither here nor there. Human beings as a whole really have struggled with dealing with glacial risk pressure. And so if you think about it from a visual perspective, we got this private credit pressure, right? And so I think what everyone was looking for last week, I didn't look. I'm to be honest with you, I didn't look. I didn't even care about it because I know it's inevitable.
When you say look, where are you saying look where?
I just wasn't, like, I knew it was bank reporting season, and I just didn't prioritize it. Like, I didn't look until the end of the week when I do, like, my recap and figure out what's going on and everything. It wasn't something I was on the edge of my seats about. Like, I knew it was coming, but I was just like, meh. I can't even tell you why. It just wasn't a priority for me because I think because I knew that the banks weren't going to say anything wild. I don't know. But I will say when I did look, I did get a bunch of confirmation about some things that were going to unfold here. Okay. So what I really want us to look at is this glacial migration of risk and pressure and how we can take advantage of it, because no one's going to be paying attention to this. And it's 90% of you guys, I love y'all, but you're not going to be able to do it or you're not going to do it. Not going to be all of you are able to do it. Not all of you are going to be able to act on it because it's going to require a good amount of discipline. Discipline. It's going to require a good amount of discipline. Okay. All right. So let's talk about the risk being migrated. So first of all, it's glacial. When you think about a glacial risk or pressure being migrated, that means you have a window.
So essentially, when you say window, what do you mean? Because when I hear a window, I think about a space where there's opportunity.
Window doesn't necessarily equal opportunity, but when opportunity can be made in any window. Window just means a gap from something starting, a cause, and an effect. It doesn't immediately happen. And so people usually recognize patterns when something happens relatively immediately. Hey, this happened and this happened. This happened and then this happened. When I flick the light on, the light turns on. Right? And so that to them they can process. But like when I flick the light on, it doesn't turn on for 15 months. Can you recognize that pattern? Okay, there's a window between when you flick it on and when the light turns on in 15 months. And so we got 15 months because the light's been flicked on.
That's a good analogy.
I know. I ate with that one.
You did. We didn't talk about that one before, but that was good.
I always save stuff, Brandon. Y'all know we have a pre-production meeting, and then Brandon always be like, you didn't say that. I know. I don't be saying everything to you. Okay. All right. So cool, right? So we got a window. So let's talk about this window and the migration. So before we even talk about the window of migration, we do need to talk about the story that the reportings from the banks did tell. So we got Bank of America, JP Morgan, Morgan Stanley, and the likes, Citi. They all reported last week, okay? And the likes. So the first things first that you notice is consumer credit is holding steady. So that's the main thing that most people are going to be looking at, right? Consumer credit is holding steady in terms of how the banks report it. So the banks change how they report it on their balance sheets after about 90-day delinquency. Okay. So when it's 90-day delinquency, it's either not on the balance sheet or they report it as future losses, depending on whatever. None of that even changed. So that means that right now, the general economy is still resilient. Okay. I have just a quick aside. Y'all know I like to do my research also in real time. When I tell you every other day a new influencer not just making money just from influencing a personality, a social media personality, is talking about big losses that they're taking, that they took. So to me, that means, like I told y'all, there's three Americas right now. We've talked about that long time ago. And that third America, the ones that are getting hit and affected by everything, that's going to be the one that tell the tale. All right, it's not a tale of two cities, it's a tale of three cities. If you read the book, then you know what I'm talking about. Okay, so that was unchanged, or it just remained resilient. Okay, so it suggested that everything was everything with the private credit markets is contained and it has not hit the general population. All right. The second thing that we saw, that they made a ton of money. The banks made a lot of money. I won't say a ton of money, but they made a lot of money from volatility.
Right. They did.
Okay. This is why I've been, how long I've been Nicole volatility? Because y'all been scared of volatility. And I'm telling y'all, volatility equals opportunity. So specifically for banks, the way that volatility, the way that it looked is when there's volatile, hedging has to be done by traders. Guess what? The banks make money off of that, off of all of these trades. They make money off of all of these trades. Also, too, repositioning. When there's volatility, things need to be repositioned. Same. The banks are making a ton of money off of this. All right. The other way that they made money, deal flow. This, every time I think about this deal flow piece of it, it really kind of points out how the system is rigged for the banks to make money no matter what. Real quick, this is a great moment. This is why you need to be on our newsletter list. I break everything down. If you are a regular viewer of this show and on the newsletter, please let them know how much I break it all down in the newsletter. You need to get the full picture. Some of y'all understand things better when you read it and you see the outline. I know the show is entertaining and I'll be giving y'all game, but I really give a full game away in the newsletter. Go to the link down below, sign up for the newsletter. It is absolutely free. Sign up right now. Every time I think about this deal flow piece of it, it really kind of points out how the system is rigged for the banks to make money no matter what. Because while everybody else is suffering, and I'm not here to try to bash banks, but just the way that the system is set up, and y'all gonna have opinions about this. Who set it up that way? Why it's set up that way? John D. Rockefeller, J.P. Morgan, all the people y'all gonna have opinions about. Have at it in the comments. But deal flow. So like mergers and acquisitions, when debt needs to be restructured, whether it's with that bank or not, they go through a bank. Any type of deal, investment banking.
Break that down a little bit.
So basically, investment banking is large corporations and very wealthy individuals when they have a material activity.
Okay.
They usually do it through banks. Hey, I'm give you just one.
Let's talk about
extreme example. Hey, I'm super rich man, and I got some debt. This is not even a corporation. I got some debt that I need to restructure. We got to go through the bank to restructure it.
Okay.
Or they typically go through the bank to restructure. Hey, we're merging. Okay. You go through a bank to do a merger and acquisition. Hey, there's an IPO. Banks do IPOs. Deal flow for them. Big deals. They're making money while other people aren't. Go ahead. Now your question. Sorry.
I think you just answered it actually. But I'm glad that you said the IPOs, because there's a lot of IPOs that are about to happen over the next
90 days.
Yeah,
60,
over the course.
Well, like 30 to 60 days.
Explain briefly, if you can, the deal flow of an IPO. Like, of how that breaks down.
So basically, we have an insane amount of IPOs about to hit the market. The market might not even be able to sustain all of this money or all of these opportunities. So let's say, for instance, I can't remember the name of this company, but we're going to use for an example, let's say SpaceX. SpaceX is not on the calendar yet, right? They can come anytime this year. It's not on the calendar yet, but there's a bunch that are on the calendar.
Yeah.
So SpaceX, privately held company. Hey, we want to go public. You go through a bank. What the bank then does is says, okay, what's the allocation of your total shares that you want to put on a public stock market? In order to take that down, they then allocate a majority of that to large institutions. You want to be that main bank.
Got you.
That does the IPO. Okay. You then take that. You take those shares. Then you allocate it to large institutions. Those institutions. The reason why it's a problem and why it's even notably talked about right now is because in order to get into new positions, these institutions, these large investors, they have to sell other stuff.
Yeah, they gotta get liquid.
They gotta get liquid. So this means more volatility.
Mm-hmm.
Okay, that's not going to show up in obvious ways. So as this stuff start hitting the market, they're going to be selling stuff off. There's going to be a huge sell-off.
And I think that's what people not.
They're not realizing. So
Yeah.
if you're a trader, you need to prepare yourself that there may be some dips.
Mm-hmm.
Okay, so there's going to be a huge sell-off in the next 30 to 60 days to make room for this. It doesn't necessarily have to be, hey, we have to sell another stock. It can be, hey, we have to sell some real estate.
Mm-hmm.
Hey, we have to sell some private credit.
Mm-hmm.
Hey, we have to sell what? Well, all the funds are limiting redemptions, but
all of that is going to happen at a glacier pace.
not at glacial.
No?
That's going to happen at a fast pace.
That's going to happen at a fast
because we got
pace.
30 to 60 days, not including. So I can't remember the number of it, but it's like some ridiculous amount of IPOs hitting the market.
Yeah, like in the next
Right,
2
it's like
months.
20
Let's just say
billion
2
versus normally a 3 to 5 billion or
It's a
something. I did
lot.
a short on it.
Yeah.
I'll clip it here. Clip the little segment here. Over the next couple weeks, the U.S. stock market is set to accommodate a staggering 15 billion in IPOs. To put that in context, over a normal 2 to 3 week period, it usually can handle 3 to 5 billion. So that's all going to be hitting the market.
Well, I think it's going to hit the market at a fast pace, but I'm saying, well, I guess to get liquid though, that's going to happen at a rapid pace too.
Yeah, I mean, you get liquid, you're going to have a sell-off in order to. Now, for a long-term sustainability, you got all of this new IPO activity, which these types of effects really scare me because we already know that inflation is crazy high.
Mm-hmm.
I hate the rich get richer and the poor get poorer. Like, we're seeing it in real time. You mean to tell me that people might not have jobs and Wall Street is bringing we're doing IPOs at record numbers?
Right.
And we don't even, and some of them are tech companies. We don't even know how tech is real risky right now. This is like, if you had to take human consciousness and put it into one being, this is totally irresponsible.
Mm-hmm.
Like, hey, I don't know how I'm gonna pay my bills for my basics, but we're gonna do this stuff over here.
It's kind of like the ecosystem is changing though, because it used to be checks and balances per se, right? Because not really, but it's like the sharks are eating each other and the whales are eating each other. No, it's like no need for more of the bottom fish really anymore, because now the
But we talked about this before. Like, the bottom fish provide more volatility.
They do.
And unpredictability.
Right.
And wealthy people don't want to put the hands of their wealth into the unpredictability of the not so wealthy.
Mm-hmm.
That's another conversation for another day. The link to that podcast episode will be linked down below when you want to go and talk about that. But okay, that's how the banks made their money. The other thing I want to talk about from the earnings reports was just overall, the bank index is underperforming the S&P. Keep that in mind, okay? And then the last pattern that I want to talk about is private credit exposure. There is some indirect private credit exposure for the banks. The banks can make loans to the private credit lender and provide lines of credit to them. So it's indirect, okay? All right. The other thing, we're going to back up and take a step back from the banking, the earnings reports, and we're going to look at what the banks have been doing. All right. They've been seeing this coming down the pipe. They've had the private credit exposures that they've had. They have sold their exposure, their risk exposure, to insurance companies. Y'all know I've been talking about insurance, and this is the main thing you need to be looking out for right now, okay? Let's come back to that in a minute. I just want to make sure you know, did you realize this?
Mm-hmm.
They've been transferring their risk to insurance, all right? Our question for this episode, I'm stealing the show for the question. Actually, we'll do two questions because I have two questions. I have a question, and then you can bring up your question.
Okay.
All right. So the biggest thing that I notice with the banks, they're literally monetizing volatility and stress. They're monetizing volatility, stress, and pressure.
Makes sense what you're saying, but it doesn't make sense.
Okay. Tell me what doesn't make sense about it.
How?
I'm going to give you a real life example that you guys are very, very close to. This show, this podcast, I keep telling y'all picks and shovels. How many times I'll tell y'all picks and shovels? This show, the reason why, let me just back up. I've been trying to talk about macro for years. I started my entrepreneurial journey talking about macro. No one cared. Y'all didn't care. In 2022, I had a real estate show talking about macro though. Y'all didn't care. Just a few of y'all, not a lot. Y'all didn't care. Now, here we are. No one knows what's happening in the world. Y'all care. It probably is not y'all though. It probably has a lot to do with the format. It has a lot to do where my headspace is and just a whole bunch of things. I'm not entirely putting it on y'all, right? But my point that I'm making is I'm monetizing volatility. It's gonna be volatile. Whether the market's up, market's down. I'm gonna do a darn good job of telling y'all what's under the hood through my lens. No matter it's up or down.
Yeah.
I'm monetizing volatility.
Yeah.
Guess what the banks did? Whether it's up or down, y'all gonna make trades. Y'all gonna make more trades. Y'all gonna care more. Y'all gonna make more trades. Run it up. Come to us. Not only gonna make trades individually on a retail level, y'all gonna make trades on an institutional level, but y'all gonna make big giant trades on a corporate level too. Because now y'all merging, y'all acquiring, y'all feel like y'all got to do something.
But it gotta go through the bank. But you gotta come through me first. Okay, I get what you're saying.
Okay, so my question to you is, I'm gonna give you a prompt to run through chat. Listen, if you do it now, you come back and watch the rest of it. Do not go down the rabbit hole because you got to get the end. I have some major game for y'all, strategies about how to take advantage of this. But I want you to do a prompt. Do it while we're on the phone. Not on the phone. Do it while we're on a video, okay? Don't close me out. I want you to run a prompt. Hey, based on everything that you know about my business, chat or Claude, whatever you choose, pick your poison. Based on everything that you know about my business, tell me how can I monetize the volatility of the market from a macro perspective and from a micro perspective, based on everything you know about my business, related to actionable things that I can do over the next 30 days to 1 year.
Fire.
Give me 10 to 20 suggestions. Now I want you to do that. Come back. Don't go down the rabbit hole because chat won't be like, da, 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 da. Would you like me to do this? Would you like me to put it into a spreadsheet for you? Actually, I was thinking if I was going to try to give you more prompts because I want you to stay in the app, but you got to pay attention to this, okay? So do it, come back, whatever, however you want to do it. Okay? All right, that's my question. Okay? Did we get to your point where your question is? Or
not
is
yet.
your question
Not
later?
yet. Not
okay.
yet.
All right. Y'all. Okay. So based on everything that I just said to you, the banks have been transferring their risk to private credit to insurance companies. I'm going to recap to you how this whole insurance thing works. All right. So it's important to note that insurance, life insurance, and annuities have increased their risk, or private credit companies have doubled their exposure to insurance and annuities over the past 10 years. I gave y'all this stat a long time ago.
You say double their exposure, you mean?
They own them. They own the insurance companies.
Heavily invested in a
insurance companies.
Aggressive pace than ever before.
So because of that, because it's private equity, because of that, remember they used to be owned by nonprofits. Because of that, they have to get more, or you already know what private equity does to any institution or industry or whatever.
Right.
We got to juice you. Because of that, they have gotten way more aggressive. So the way the insurance companies work is you got insurance companies, then you got reinsurers. Reinsurers are usually based in the Caymans. Why do you want to be based in the Caymans? Because the regulatory laws is super lax. You are allowed a level of opacity. That means you don't have to tell everything about everybody. Everybody about everything. In a respectful way. I'm not saying that there's anything shady being done because y'all know I fact checked this and I'm already going to run it through chat and chat's going to be like, you said this and leave me alone, chat. And leave me alone to all of you critics out there, okay, too. So it's a lot of opacity just by the nature of doing business in the Caymans, okay? These reinsurers owned by private credit, it's just opacity there, period, point blank. So there is a market for providing liquidity to companies in which the probability of them paying is really difficult to determine. So which the layman's terms of that is there is a market for packaging up illiquid debt. But it only works from a systemic, since we're using that word, it only works when it's done at scale.
Okay.
There are very few industries that can handle providing liquidity for these types of assets. Because of the nature of insurance, you've got these long-term maturity dates. It's perfect for it. Also, the value of these assets, private credit loans, is not traded on a daily basis, so we don't really know what the value is. The private credit funds are determining the value.
And you saying the value of the loans, or you saying based upon the interest that's paid back in?
Based upon the interest, the probability of it being paid back, the company's credit range, the probability of their the growth of their business. Remember, 25% of it, based on the Wall Street report that came out a couple weeks ago, 25% of it is invested into IT companies. And you know, a good chunk of that is AI.
Right.
And I'm going to keep going back to, we don't know how AI is going to really be monetized.
Yeah.
The only thing that we can guarantee is that the government's going to buy it. Other than that, you got the puppets going out there, your Elons, your, what's the dude's name that
Who?
AI, OpenAI. As I'm talking about chat.
Sam
Altman, yes.
Yeah.
You got these guys going out there going on a whole entire PR stint to tell you as a human how much you need it. And everything you need is already inside of you. But I don't want to get that's a whole nother conversation.
I went through a Claude rabbit hole over the weekend about AI, and I compared it to the .com bubble. I asked Claude about the picks and shovels because now that's the thing I just use now, picks and shovels, because that's all you say. Essentially, it talked about how Cisco was the foundation laid all the foundation of everything as far as the .com goes and the internet. Now AI, because you said the government is going to buy AI.
I didn't say. I said it's the only way that we know that it's monetized. The government go into these contracts. We know the government AI. Hey, we can monitor human beings at a super high level. We can track their heartbeat from 6,000 miles away. I don't need your heartbeat from 6,000 miles away.
Yeah.
It's illegal for me to track you. Like, you're trying to convince us that we need it for thinking and computation, that really the average everyday human has no use for AI. Other than helping me to write an essay, or other than helping me to fold my laundry. Like, for real, this machine that we got, we good.
That was really deep what you said. The average everyday person don't need AI.
We don't need AI, but they're trying to convince you that you do. But they will, and then you'll need AI at that point. Because you're going to be thinking, you know, I saw this video of this guy made this AI where...
Dang, that was really profound. You got my mind really like just jarred when you said that though. Like, you really don't need AI.
We didn't. I keep been saying this. We don't want it. Y'all are trying to push this on us. Oh, like, I hate when it be like, this is going to push humanity forward. What are you talking about? Did we ask to be pushed forward? We're fine. Other than a couple of you bad rotten apples that we want to get out of here. I don't mean. I mean.
I
That
think
in
that's
the
the
most
difference
loving
right there
way.
between the
I mean,
.com.
by get out of here, I mean like you go to Bible summer camp. That's what I mean by we want to get you out of here. I don't mean anything wild, okay? We
Bible
lay
summer
hands
camp.
on you. That's what we mean. We want to pray for you. Maybe perform an exorcist.
Get it out of here. So the internet did push humanity forward, I would say, in my eyes, because it gave us a certain level of advancement.
So let me go back, because you looked at the pattern. I was waiting for you to say this pattern. When you look at the pattern of the .com boom to this, and this, I've been saying this, but I'm going to say it in a different way. When you look at the pattern to the .com boom to this, I cannot remember. I just saw a stat that said of all the companies that did an IPO in this certain time frame, only a few of them still are alive.
Right.
So it pushed us forward, but not in a way that they thought that it would. The same way right now, AI is going to absolutely push us forward. There are jobs that we just don't want to do as humans. Hopefully, if we do it right, we will literally eliminate, because slavery is still happening around the world.
Mm-hmm.
We will eliminate any reason for anybody to want to enslave somebody else. You should never want to enslave another human being. You have no reason.
Yeah. More
If we do it right.
Yeah.
If we do it right. Again, I always say, nobody wants to get the dookies out the pipes.
Mm-hmm.
Plumbers, do you like your job when you gotta get the dookies out the pipes? You gotta sweep the dookie up out of the basement.
Somebody got to do it, though.
Somebody gotta do it. AI, come on, stop making dancing robots. Why you got a robot walking down the hall with Melania? That robot need to be in the pipes. Why are we doing this? Okay?
Yeah.
Fast forward. We don't need AI. Okay. I want you to finish your sentence about, you were saying that you had a conversation with Claude about AI. I stole the show. My whole point that I wanted to get at, because I was going to wait for you to get there, my whole point that I wanted to point out or even notice is that it is very similar. I said this from day one. When the internet boom happened, they was using it for toys.
Remember pets.com?
Right. Remember, and at the time, we didn't need pets.com. Mm-hmm. Now we do. Our lives are so cumbersome, you got to order the stuff on the internet. Mm-hmm. But at the time, our lives were way more simpler. And so everybody was making all of these toys and games. And so here, look, Sora, gone. We don't want to look at AI riding a bike off a cliff.
Yeah.
Guess what? Tom Cruise is willing to do it for free. You didn't get that. That was funny.
I'm sorry. I'm going through my cloud right now.
Tom Cruise ain't doing it for free, though. Tom Cruise will do it without nobody asking him to do it. We don't need AI to do it. What's up to my boy Tom Cruise? If you know me, you know Tom Cruise is one of my favorite actors.
You went straight Mission Impossible.
That's my guy. Now. That's my guy. I love you, Tommy.
I love you, Tommy.
I love you, Tommy. So, okay, I'm leaving. You taking me off my thing. I'm coming back.
Okay, all right. I'll bring you back.
All right. I don't know what Brandon was talking about with AI, but that was a fun little aside. Okay, the banks. The only place for the banks or anyone really to offload their private credit exposure, the only place that can handle the risk as of right now, because there's a couple of options I'm going to share with you, the other alternatives, is insurance companies. But even that has its limits. Did you know the Treasury is meeting with insurance companies because they know that it's hiding in the Caymans? So they're holding a series of meetings. They announced it literally the same day that Donald Trump made all them crazy tweets. They announced, hey, we're going to have a series of meetings to figure out what's going on with the private credit issue. This is what the U.S. Treasury has decided. Okay, one of the things that they're trying to do is we're trying to figure out for insurance companies, how much of a risk is this? We don't know. Y'all not telling us what's going on over there down in the Caymans. We need to know now.
I know how we got to where we got to, and now I can bring it back too, based upon what you said, because as far as insurance goes, there's no insurance for AI. Like, as far as you said, 25% of it we know is invested in AI, but there's no insurance for AI. One, we just stated, we really don't need it. But two, if you have AI and robotics at this point, because AI is going to give life to robotics in a different kind of form or fashion, and it replaced things that a lot of people once did, who is going to pay those taxes at that point? Nobody's paying taxes.
I think you touched on like three things and you're trying to merge it together and it's not mergeable. Who's going to pay the taxes on?
So I'm gonna bring it home. I'm gonna bring it home when I say there's no insurance for it, because if they're invested in AI and there's opacity, essentially what I'm trying to get at, there's no real backing to it.
There's no backing to what, AI?
Yeah.
What are you saying?
Like
insurance is not going to provide that. That's not how insurance works. Insurance will indemnify you in case of loss for something that's very predictable. That's like saying, hey, I'm going to get insurance, lip gloss insurance, in case I, break this lip gloss. Like, that's not predictable. First of all, it's not worth, like, let's pretend like it's worth of something of value. This is not predictable. They cannot, from an actuarial perspective, they cannot predict this. This is not something that's going to be, maybe you can get some insurance on your AI robot, like, but we're not talking about that type of insurance. That's why I'm trying to get you. You keep going into like regular consumer insurance from that perspective. What I want you to think about is, no matter what type of insurance it is, in order to have an asset to back the policy, you have to put an asset in it that outperforms this policy. Because insurance companies got to make money. So it doesn't matter what it is. Let's say whatever you're saying that we need to indemnify AI, that doesn't change anything. They need assets to outperform the indemnification of whatever this asset is. Specifically right now, the assets that are being indemnified with private credit is life insurance and annuities.
Okay.
Okay.
That was the question I was about to ask you. I'm glad you answered that.
So, because life insurance and annuities, this is very predictable. You already know they can predict. You go get a policy, they got a file in there that nails down to the month when you're going to die, based on your habits. And even now, they could probably base it to the minute based on AI and all the data that they steal from you. I know I've been said this though. You getting hype right over there.
No, but
I've been said this. I said that insurance companies at the top.
AI. That's what you said.
No, not based on AI. They're using AI. Not based on AI. They're using AI to predict you.
Yes.
What is the outcome that they will be indemnifying with AI? The outcome that they're indemnifying with you through life insurance and annuities is when you die. Mm-hmm. What is the thing that they're indemnifying, that they're predicting with AI? If you're saying that they're going to insure AI, the only thing is like, oh, this robot will live 10 years. Here's your insurance. Here's your protection package that you buy when you like.
No, what I'm saying is how insurance is able to predict the lifespan of people is based off our normal habits of how we used to operate, our systematic operations of how things used to be. When people no longer operate the way they once did,
AI is introducing a variable in there that they can't predict, is what you're saying? Because that's not what you were saying at first.
Well, essentially, yes. Essentially, what I'm saying is the backing right now is so propped up on the success of AI. Like we've been talking about,
it's like a different conversation. This is why I keep saying, you're talking about the backing of the success of AI. I've been said this. Life insurance is at the top of the food chain. This is cute. Life insurance is at the top of the food chain.
So you don't think that the success of AI is kind of like one of the backbones of insurance?
No. First of all, it's new. The government in the U.S. economy is placing a huge bet on it. We don't know how much money it's going to make or how it's going to be monetized. Mm-hmm. They're trying to convince you that you need it. They have not successfully done it yet.
Okay.
My bet is that they won't be able to successfully do it because the one thing that human beings keep trying over and over and over and over and over again is reduce your free will. They're trying to control and reduce human free will.
Okay. So
You can't. That's how God set this up. Like, I don't care what y'all doing. You can't do it.
so as far as insurance and the backing of the premiums, if we talking about the backbone, right? We talk about the spine, the assets. Give me just two vertebrates. I know you said annuities, right?
That's all you need to worry about. The news in life insurance. You keep wanting to go to car insurance. That doesn't affect our economy in that way. Annuities and life insurance. Those are the ones that's like really jumping with investing in private credit, and that's really the meat and potatoes. Because I know, based off of 200,000 years, there's trends, there's ebbs and there's flows, there's valleys and there's peaks. But based off 200,000 years of human behavior, I know when you're going to die. There's nothing more predictable than that. Insurance companies are the most successful companies in the world. They are old. They've been around for a long time. They survive every major catastrophic event. There's nothing more I can predict more than when you're going to die.
I'm gonna be devil's advocate here again
God.
one more time because
What?
now with AI, they're trying to make people live longer. They're trying to.
You think that's what do you really sit here and think that is the goal of AI?
you?
Do you think that, like, I want you to think, just sit for
Maybe
10
it's my
seconds on it.
algorithm. I don't know. Maybe it's my
You
algorithm.
think that AI is here to prolong human life?
They are trying to make people live longer, according to my Instagram algorithm. Okay, the stuff that is on my
You think
feed.
that AI and Sam Altman cares about prolonging?
I'm not saying that
your
they
life?
care. Hey,
Brandon, I'm sorry.
don't you laughing at me? They are. They talking about making people live for at least 100 years.
No, they're
now.
talking about making rich people live, like longevity. That's a cool thing. They're talking about downloading Sam Altman, Elon Musk's brain into a.
Right.
They're not people. That's not people. That's 5 people. You think you're gonna have access to that?
I don't know how to hog tie people.
I don't know how to hog tie people. Y'all, I'm sorry if you follow me on Instagram, you would get it. If you don't, I'm sorry. Real quick. So we got a bunch of book orders for my book. The Anti-Hustle, like a lot. Shout out to y'all. It's a Christian business book. But look, we got orders in Canada and the Cayman Islands. So my reverse response is, I don't know how to, I can't get it out. I can't get it out. Because it was so natural. My response was, I don't know how to mail to Canada. But in my mind, I was thinking, I don't know how to hog tie people.
I don't know how to hog tie people. What would I hog tie?
All right. You killed me. I got no more questions after that. You think you're gonna have
He
access to
said they want us to live longer. Listen, if they wanted us to live longer, it will be a whole cahoots with the insurance companies. Yeah, we don't mind if they live long, as long as we get to pull the plug on the day, in a minute, in an hour. I don't want to go too deep in my conspiracy with that, but I'm mad that you thought that Sam Altman cared about prolonging my life.
You know, they saying all these new profound things that are coming out. We know how to cure this. We know how to. AI is figuring out this.
Child. People don't care about your lifespan. All they need to do is predict it. They can predict, if they shorten it, they can predict it even better. But if you live in, human beings right now, based in biblical times, we supposed to live to about a buck 20.
Yeah.
Just imagine, they can't let you live to a buck 20 because if you stopped working at 60, how they gonna pay for you from 60 to 120? Oh, child.
Questions that need answers.
No, they have answers. Y'all, I don't want y'all to understand I am holding back my laughs. 'Cause I want to laugh about this for 10 more minutes.
I do too.
As a conspiracy theorist, this is how I be when people be like, assume that like the government like wants us to like flourish. Like we could 10 years ago, I could go to we could go toe to toe with that argument. Not no more. They'd be like, "Is this on? We don't care about y'all. Thanks." Announcement for April 20th, 2026. We don't care about y'all. Thanks. Good night, everybody. Announcement for April 21, 2026. We don't care about you again.
Good night. It's been great.
Good night. It's been great.
Okay. Understood. Understood.
And that's all right. I don't need them to care about me.
But
I mean, it would be nice to feel protected. It would be nice to feel protected, but like, I'm not relying on them to like sit up and be like, dang, I hope black women are doing well. I'm just not.
so essentially,
Y'all can put
that's
my
the
behind
only
in
way
the
that
gym and eat healthy and be nice to y'all so that y'all
the life cycle has to stay the
for
same.
me. I'm not saying it doesn't stay the same. They just need to be able to predict it. But that's the least of their concerns right now. The biggest part of their concerns is they need to be able to back the assets based on their prediction. Those assets need to outperform. And we're going to hold them because you're going to live a long time. So that's the thing. We don't need liquidity. That's why insurance company is very it's a very unique industry to be able to hold these illiquid assets. Hey, we're not going to sell it. We're not going to be trading it. We don't particularly care to, but we needed to outperform the return you're getting on this annuity and this life insurance product. And guess what? We're private equity, so we wanted to really outperform.
Okay.
All right? Okay. Now, with that being said, I got a lot more stuff I got to get through to y'all. We already have 48 minutes. I got to really get this out in like 20 minutes. Okay. There are two avenues in my prediction that this will go since we have this window. So I want you to think about the window. Private credit situation is happening up here and then it trickling down here. We already know the banks told us that we're somewhere here in the window. We out here just living a good time.
Mm-hmm. The light switch. I love that analogy. The light switch. They turned the light switch on.
The light switch off, but the lights are still on. Or
Right.
however you want to go.
Lights off, yeah.
They turned it off, but the lights are still on. We having a party. Paying our bills. We having a good time. Okay. We need to be preparing for when that window closes, when the lights actually go off. All right? So we still have a window. How long is that window? This is just a true guess. Maybe I'll put some numbers to it later and give you all actual guess. I think the window is like maybe anywhere from a year to 3.
I say 3.
3. All right, let's say it's 3. Might be 6 months. I doubt if it's 6 months though.
I don't know that fast.
No, it's not. It's not gonna be that fast. A year to 3. But don't hold me to it.
How long
If it
he got
happens
left in
6 months,
office? 2 years?
You think it's just gonna happen as soon as he get out and then boom, window closed?
No, that's why I say about
Lights
3.
off.
Maybe about 3. Like the first year until whatever happens after this last.
He ain't leaving office. He said he's not leaving office. But that's another conversation for another day. I need to get through this. I really want to laugh some more because I need to get through this. Okay. Okay, so we're here. Okay, so the route to the lights going out is either going to go one of two ways. This is Nicoleism.
Nicoleology.
Nicoleology.
Nicoletheism.
Nicoletheism.
Okay.
It's going to go one of two ways. I'll give the way that I think there's just be more colorful to be more fun. I'll give that second. First way is just straight private credit to banks route. Okay, so first, obviously private credit underperforms, which we're lightweight seeing right now. Then the banks pull credit lines and collateral deterioration. Because remember, I told you that they have an indirect relationship with these private credit loans. So this starts to underperform and they're able to just like pull it. Then the banks get defensive. Then the credit availability shrinks. Then next step, deals flow drop. Because remember I told y'all that the banks made a lot of money from deal flows. Now, I'm not saying that banks can't make money other ways because it's a whole bunch of different ways that banks make money. But right now, deal flows is like a huge thing for them. So if credit is not available, deal flows drops out. So that's not a leg that they'll be able to stand on in terms of performance. Then the markets become less functional. Then the volatility that they were making money on, where it's like two-sided trades that they can make money on, that spread. So one thing I didn't go into about, they made money on the volatility because there is a spread, right? The spread between the bid ask, when it's volatile, it widens. Okay? If the markets are constrained, the markets then become one-sided. And that the spread between the bid ask is maybe not a big spread, or maybe there's one side that's like, hey, we're selling, we're not buying.
Right.
We're selling, we're not buying. So that pulls back. They can't make as much money from volatility anymore because of the lack of credit availability, and then thus banks earnings weaken. Okay. And then now you can understand how that would affect everybody. So that's the remainder of the window. That's one route. Like directly from private credit, hey, it hits their ways of making money. Because if these bank reportings their earnings didn't come back strong, guess what that means? That means the credit is tight. It's just not going to be beneficial to them to provide liquidity to you. Okay? All right. So it can happen that way. Now here's the other more colorful way. Scenario number 2. This is my favorite way. And let me be clear about saying favorite. It's just my favorite way from a thinking standpoint, but I hope neither of this happens. I can't imagine a world where it doesn't. I don't know. I can't imagine, unless the Treasury and these insurance companies come up with some way to contain this, some magical way to contain this and put it in a bomb and put it in the ocean. I can't imagine it, but let's go into scenario number 2. Scenario number 2 is the insurance route, okay? First step, private credit underperforms. Second step, the insurers take the hit, because remember, they got the private credit on their balance sheets. They take the hit. Next step, they become more defensive. They stop buying credit. Companies fail. Companies lay people off. People don't have jobs. Okay? I do want to very briefly talk about a extreme scenario is like everything just completely implodes and, these loans don't get paid back and everything just completely implodes, because there are some backstops. There are other industries that can handle these assets, but not like insurance. You got pension funds, sovereign wealth funds. When I was like doing research and really thinking about this, I immediately thought about that's the first thing that Donald Trump, one of the first things that he set up when he got in office, or he's setting up the sovereign wealth fund.
You mean
a government that has a fund? A lot of governments, very wealthy governments around the world, they have their own private equity fund. That's another conversation for another day. Let me know if y'all want to talk about sovereign wealth funds. That'd actually be a really fun episode to look at sovereign wealth funds around the world. Okay, because I'm a fund manager, I've done a deep dive on this because I wanted to, especially, so what happened was we started the fund, and then so now, like, this is going back a couple years, so now my eyes are like super peeled. Then comes on my ticker, Donald Trump started the sovereign wealth fund. This is right when he got in office, and I was just like,
is that what the 2000, like they put
the kids? No, that's not that.
That's something totally different.
I want to keep going.
Okay.
Don't take me off.
All right.
Okay, so that is something different. And so I did that little episode on YouTube where I was like, Donald Trump stole my strategy. Like, people have been doing private equity for a long time, but that was just like clickbaitish. But we never had a sovereign wealth fund before. Mm-hmm. But a sovereign wealth fund could potentially, depending on the size of it, I don't want to say only our fund, it could be other sovereign wealth funds around the world, could potentially absorb something like this, but still not the way insurance companies can. I'm trying to remember some of the others. Yeah, I can't remember some of the others. Maybe I'll post it in a caption. Some of the other alternative industries or sectors that could potentially absorb illiquid, underperforming assets to continue to provide liquidity to markets around the world.
So one of them was, you said
pensions, sovereign wealth funds. I cannot remember the others. Yeah, I'll put them in the caption.
And you just basically saying
it's not even really important. Because they're
being able to pour out money when stuff is at a halt.
To be able to hold illiquid assets for long periods of time
And still provide liquidity though, right?
Yes, when you buy the assets, you're holding it. Like, hey, I buy the assets, these illiquid assets that might not even be trading to value. We don't really know what the value is because private credit loans aren't on the market every day getting priced every day.
Right.
So it's very illiquid. Who else is going to buy a private credit loan? You need to be able to hold it as the owner. You need to be able to hold it to maturity in order to see the appreciate or see the cash flows, see the interest. You need to be able to hold it.
Right.
There's not a lot of people that can do this or industries that can do this. Hold these illiquid, underperforming assets. Okay? All right. So that's an aside. I'll post the other ones down in the caption. I cannot remember them off the top of my head. Maybe I'm going to put them on the screen. That's what I'll do. Put them on the screen. Okay. So the question is, what are we going to do about it? How can you take advantage of it? With that being said, go on with your question that you have for the community, for our friends.
So my question was based upon what you were going to get to, based upon the end. And now my question doesn't really make sense in the essence because
I'm glad I stole the question show.
It was more so, but what happens on the flip side when those illiquid assets are defaulted? They don't reach a maturity. Like, you provided liquidity, the pension funds, your sovereign wealth funds, and then something happens. The system changes on you.
Basically, let me make sure I hear what you're saying. If the insurance companies hold these private loans and then it's just mass defaults, like nobody's paying, what's the worst case scenario? So you're thinking like, hey, the insurance companies collapse, they don't pay their interest or their annuities or something like that?
Not really the insurance companies. I'm talking about the alternative companies that are able to, like the pension funds, like the.
That's what I'm saying. That's so left. So if the pension funds are holding these private credit loans, here's the thing about pension funds. This is why I'm saying that they're alternatives, but they can't absorb it because pension funds usually have really strict bylaws about how risky they can get and what they can invest in.
Well, I guess essentially it would be the insurance too, the insurance companies, because they would be the main player in it, and then like you said, the pension funds and things like that will be alternatives to pick up the slack. But
nobody's saying that they will. I'm just saying if these private credit funds have bad loans, or let's say the bank have exposure to these loans,
right,
and they're punting the exposure to the insurance companies,
right,
okay? Why insurance? That was my question. Why insurance? And I had to really sit back and think, because they can hold illiquid assets. Who else can hold illiquid assets? I made a list of who else can hold illiquid assets. Pension companies. But pension companies can't take it the way insurance companies can.
Right.
Because a lot of times, as a trader, I'm calling pension companies, hey, buy some of this, buy some of this. And they're like, Nikki, we like you. Everybody called me Nikki back then. Y'all can call me Nikki. Nikki, we like you, but it does, like, I'll give you a perfect example. When 2008 happened, I was selling commercial paper. I feel like I told this story to y'all. I don't know. I'm selling commercial paper, right? Because everything blew up. Our paper that I sold, the company that I sold commercial paper for, was AAA rated, the best in the world. But because everything blew up, we had to end up paying more interest, and there was a lot of pension funds that said, no, we can't buy, and then we're talking about overnight paper, 30-day paper. Nah, we can't do it. So I had to pick up the phone and call a huge fund and be like, listen, we have this need. We got all this paper due. Nobody's buying our, like nobody, it was just frozen. It was liquidity was frozen overnight for everybody. It wasn't just us. Mm-hmm. Hey, we need to do this trade. I need to, can y'all take, let's say it was like 500 million. Can y'all do 500 million? That particular fund that can normally do a very little bit with us, I had to give them some crazy amount of interest over what we normally will offer. And in order to, he knew that this was an opportunity. The main trader on the phone, he knew this was an opportunity. We had to go through multiple levels of approval to be able for the fund, because they also didn't have a lot of places that they can place their money with, because everything changed overnight. So he had to go through multiple levels of approval to be able to say, hey, we'll do $1 billion trade with you, Nikki. Because in their fund rules, they couldn't have more than 10% in one security.
Okay.
But, hey, desperate times calls for desperate measures. I don't know where to put this money, because all of a sudden, my list of approved places that I can put this money has changed overnight. But because we was goody two-shoes over there, normally he didn't want to mess with us because we were AAA and we didn't pay enough yield for them. But guess what? You don't have no place to put it. And then guess what? We also getting funky too, because everything changed. So what I'm saying is, pension funds is not reliable. This wasn't a pension fund, but they were my customers too. Pension funds are very conservative. Not very, it depends. Pension funds can be conservative. Again, insurance companies, they can get funky with it, especially now that they're owned by private equity. They can get funky with it. Yeah, we want some of that private credit that's giving 25% yield. I don't know I don't know. It's all opaque. No one knows 100% what it's paying, who it's paying, how they basing it.
No one knows what it means. It's provocative.
It's provocative. Who knows? Do you understand what I'm saying? So pension funds is not a real solution. So I don't want you to get hung up and like, hey, we'll go down the list and we'll go. I'm just naming places that is possible.
Okay.
It's not a solution on paper. Insurance companies, if they do go default, they do have backstops. They have regulations. They can't just take 100% private credit. They just gotta, on the next cycle, they just gotta get extra conservative. No, we cannot provide liquidity for these funky deals that you guys wanna do on the next go round. Guess what? When we don't provide liquidity on these funky deals that you gotta do, hey, guess what? That's your employer. Your employer couldn't make payroll. We gave them the loan. We're not giving them the loan again. Guess what they can't do? Make payroll, lay off. Do you understand now?
Yeah, I got it.
Okay.
I understand why you say insurance is what it is.
Right. All right. Let's talk about what you can do about it. Okay, first things first, we're going to be defensive. Clean up anything that needs refinancing. Refinance it quick. Refinance it quick. Because it's going to get uglier. That's just my opinion.
It's going to be harder to refinance.
It's not investment advice, but right. But if y'all thinking like, oh, rates are high, we'll wait till they come down. We're at war. Okay. All right. Next thing. I keep saying, go after income generating assets. Strengthen your income. Okay. Focus on businesses, income. Don't just look for that wealth play. This is partially why I was like, hey, single families right now. No, because a lot of the play is, hey, it's building wealth. That's not really the time for this right now. You want to build wealth, but income producing assets. Real estate sometimes, especially with single family, especially depending on the market that you're in, their margins is real slim in terms of your cash flow from a particular on a door basis, right? If you're using mortgages, right? We already know mortgages are high. I'm not saying don't do real estate. I'm just saying don't do real estate. I'm saying don't do real estate. Don't buy single families. I'm super joking. I'm not playing. I'm really not serious. Do multifamilies, do real estate, but just make sure your deals is really, really got a lot of meat on the bones.
How can people do multifamilies though? Or how can people get involved?
How can people get involved in multifamilies? We have a private equity fund where we invest in apartment buildings. If you want to get 20% IRR on your money, 2.5x equity multiple, 5 to 7 year hold term. We have a fund. We invest in apartment buildings and assisted living facilities. And I would love to make a ton of money with you. Let's do it. So no, seriously, I'm just joking. I mean, I'm serious, but if you want to set up a call to learn more about our fund and you're looking for ways to like really get funky and take advantage of all of this, go down to the link below and just fill out. It's a very, very simple form. It takes you 2 seconds to fill it out, and then we'll schedule a call. All right. What you want to do is reduce dependence on, like, I want you to think about exit on any deal. If it requires, hey, I'll just sell this, or hey, in order for you to sell something, markets have to be functioning at full liquidity at some undetermined amount of time. Reduce your dependence and your exposure on that. Flips. I've been saying to you guys that luxury flips is the wave, but you still want to be really, really mindful of the market that you do it in, okay? Because you just gotta tread lightly. I'm not trying to I want you guys to make money. There's always going to be opportunities for 6-figure, 7-figure payouts, for sure. But you just really need to be mindful, because friendly, easy exits, that's just not where we're at with it right now. Next thing, you want to make sure you pay attention to where credit is tightening first. Watch these banks' earnings reports. Go to next quarter. Put a thing on your calendar. Make sure you pay attention to where credit is tightening first. Okay. Look. Keep your ears peeled. Pay attention. And avoid overreacting too early. Remember, we have a window. I feel like we're at like the top 25% of the window. We're in a window, so don't overreact too early. Especially like even when we saw with the last week. Hey, we got a blockade. No, you got a blockade. No, we got the blockade. No, we all got the blockade. Mm-hmm. Markets was moving all crazy, and it's like, I told y'all, chill out. We're gonna be in this for 3 years. The war is over. Iran, we said we let all the ships go. I didn't think like that was such a weird, whatever.
That poses a whole new question of like, who has the capability of reacting first?
U.S. or Iran?
No, I'm just saying in general of things, and that goes back to the question that you asked me earlier. You said you think you're gonna have sex to that, but like, okay, we have to scale it back and take time to not overreact, because
all of it's a stage.
You could get burnt, right? You could end up on the bad side of the overreaction if you overreact.
It's not even about that. It's about like really using your logic and paying attention. Don't get caught up in these headlines. This is what's happening. Private credit, insurance, like all the pieces. All this stuff in between is nonsense.
Well, when I ask that question, I think from a market standpoint, because market reacted fast, right? Mm-hmm. When that happened, when the Strait of Hormuz is open, the market said yay and just reacted very fast, irrationally.
Let me take it back to you. This is what I'm saying. Unless you're a day trader and you're thinking long term, like if you're a day trader, absolutely pay attention to this. You gotta compartmentalize this differently than the way that we're processing this. But when we did the war episode, I said in 30 days, the market's going to dip 5%, 5 to 10%, I think I said. And then after that, it's going to return to normal. Guess what the news was last week?
All-time highs.
But guess what? We went down 5%. This is literally exactly as I said. But it's all human nature. It's not like, this is not technical. What happens when you get a bit of bad news? You sad for a day, and then after that it becomes your new normal. Then you figure things out. This is all this is. This is just human nature. Hey, we got a problem over here. Granny house about to go up for sale. Or Granny missed her payment. You got about a year, glacial pace, to figure out how to move, how to figure some things out before the foreclosure man's come knocking on your door. You gonna move the problem over to Aunt Sheila. Aunt Sheila gonna loan Granny some money. Granny went and tricked it off at the casino. Then you gonna move the problem over to drug dealer cousin Ray Ray. Ray Ray give money to Granny. She had to buy the kids summer clothes. Now you gonna move the problem over? You understand what I'm saying?
Versus Granny house burnt down overnight.
Right. Now I can't predict that. But what I can say is that this is a glacial problem. They're just moving risk. And so if we know that they're moving risk at a glacial pace, we have a window that we can take advantage of. Stop overreacting to this nonsense. 1 minute the war's over, the next minute is not. Hey, we talking, no we not. What are y'all doing? Like y'all are, like I get what y'all trying to do. Y'all creating a narrative and y'all are doing PR, but y'all going too far with this PR. This like now we have no morals. Y'all going too far with this. This is out of control. Y'all sleep at night? I lied to the people. The war is over. It's not over. What?
We don't care about y'all. We love you.
We don't care. Good night. God bless.
You got me laughing today.
All right, last but not least, I said this a million times. Think in phases, not predictions. Think in phases. We already know what's going to happen. We got the window. Dance in the window, dance in the window, dance in the daylight, dance in the daylight. Okay? We in phase.
Thinking phases, not predictions.
Not predictions.
What does that mean, though?
Stop being like prediction markets. Oh, they announced, the Strait of Hormuz is open. Oil should drop. Unless you an insider, these insiders been getting busy. We don't care about you.
That's it right there. That's the one. Is this thing going?
Is this thing on? Is anyone listening to me? We don't care about you.
Good night.
Good night. We're at SEC. Trading's illegal now. Suck it to you, Martha Stewart.
Sayonara. Okay.
Sayonara, Martha Stewart. Martha Stewart, wink, wink. You want to come over tonight, Bill? We don't care about you anymore. Ooh, child. Not a one persecution. Not a one.
Man.
I don't want to talk about this Epstein files. I still ain't persecuting nobody.
You said that too. You said
They
that.
ain't doing nothing. All right, we got more jokes. Okay. Let's move on to actual strategies. So, this is where the show gets repetitive, but I need to always keep coming to the same conclusion so y'all can understand this. Y'all, be liquidity. If you can understand an industry really well, if you know an industry really well, provide liquidity because it's about to get funky out here. It's already getting funky a little bit. We got for our investors assembly, for our members of the TPD community. You didn't know last week I launched a membership on YouTube, right? So they get some access to some really cool videos. So it's like 3 levels. So it's patron, like you fool with your girl, you appreciate the value, you support what we got going on. Yes. Then we got Capital Insider level. That level, you get access to some really special videos. My Bible studies. I got a bunch of surprises for you guys. But if you really serious, you want access to it all, y'all know I put y'all up on game. All my members, shout out to you guys. If you really want to really be serious, that's the TPD community. That's not a YouTube. They get access to everything. So anything I put up there in the community, they get access to that plus so much more. We got a person coming in who's talking about the changes as a result to credit, business credit, the update changes as a result of business credit, as a result of private credit, okay? But we got some really fire. Actually, we got somebody coming in to talk about institutional whole life insurance. Never heard of it. I can't wait to learn about it. And I'm saying somebody, because when y'all see the flyer, they're going to have the same last name as me. This is actually my uncle who's younger than me. So he's really my nephew. I didn't even know. He was like, hey, you ever heard of this? Because he's been doing financial stuff for years. It's my baby nephew.
Wow.
Yes. So he's going to come and do a presentation. We got some other fire stuff coming on. The whole point is You know industry really well. I've been saying this to y'all for forever. Become a lender in that industry. Get real funky with your terms. You got the power. You can make a lot of money if it's an industry that you know really, really well. Okay? All right. Next thing, target refinance stress. Somebody who needs to refinance real bad, you can get the asset at a discount. Okay? They need to finance, they need to get their way out of it. You can get the asset at a discount. That's what's happening right now. We don't got time to talk about the math, but target it. Buy performing assets from forced sellers. Okay? Sellers who's having issues. The asset is still performing. It's about to be playtime out here, especially for apartment buildings. You know a team who can do apartment buildings really, really well. Because that's what we're doing. We already knew this was coming up, so this was always our strategy, okay? Especially in Atlanta right now. Listen, performing assets is selling. Pennies on a dollar. Not pennies, but like a deep discount, okay? Go to the link down below, Invictus Elite, schedule a call, and we can talk about it. If you're going to do debt, do long-term fixed debt. Long-term fixed debt. Do not want to do variable right now. Fix it up. Took me a long time to get. Hopefully y'all got some good value from this.
I think this was a fun episode.
This was fun.
And I've been sitting at this one angle right here.
That's a good angle.
It is a good
Because
angle.
then I can look right here instead of be looking over there. They be like,
But I hope they don't kill me again in the comments. And they what you said? They said about me one day.
What did they say?
I don't think that piece of hair was sticking up the whole time right here.
I got a piece of hair right here.
No, well you just swooped it down.
I don't care.
Right.
I didn't care about that hair. I
But
didn't care
then when
about
I
it
moved to the
first
side,
time.
I just seen it. But I don't think it was on.
I don't even care.
Is this
People
thing
care more
on?
than me. Is this thing on? I don't care.